right, Stefan, welcome to Living Off Rentals.
Thanks, Kirby. Thank you for having me here.
Yeah, it's great to have you, man. I've watched some of the stuff that you've done in the past, and it's really interesting. And for the listeners' sake who are listening to this, just by way of background, Stefan is a financial engineer by profession. So, and he's kind of used what he's learned as a financial engineer in the multifamily space. He got his master's in financial engineering from Columbia University, and previously managed a $90 billion derivatives portfolio before taking what he learned in the derivatives market and applying it to the real estate market to make better data-driven decisions. He's also the founder of RealtyQuant.com. So if you want to look him up and look up what he does there, I go to RealtyQuant.com. So it is great to have you here. I'm excited to get into data and analytics, but first, your accent sounds different than a regular New York accent. I know that's where you're calling from. So if you could share a little bit of background about where you're from originally and kind of how you got into this.
Yeah, absolutely. And thank you for the wonderful introduction. So I'm Eastern European originally, so Bulgarian. I came to the States at 22 for my master's. Basically, I did master's in financial engineering. I worked in the industry, like in the finance industry for about a decade. And in the recent couple of years, I transitioned to multifamily investing. And so I'm primarily an investor myself in the New York City area. And I also run Realty Quant, which is a company that aims to bring like data-driven quantitative techniques to the real estate industry.
Got it. Yeah, cool. And so I think just to start off with, I think when people start thinking about professional finance and investing world, especially when it comes to derivatives, their eyes can kind of glaze over and they feel like this is just like, where do I even begin? Because there's like, it just seems so complex, and so you've taken these complex ideas that are more in the professional, maybe investment banking space, and applied them into a little bit more simplified investment space of real estate. And so can you kind of break down how you do that, maybe for somebody who's a little bit more slow like me, how you use the data and analytics that you've learned in your previous life in the real estate to make better real estate decisions?
Yes, absolutely. That's a great question. And so just first to give like an introduction of like how I even started kind of applying some of those things. I wanted to find like, I started in the real estate space by purchasing a fourplex in New Jersey, like by New York City. I moved in, like kind of the typical house hacking story. I moved into one of the unit, living rent-free sort of, like the usual, house hacking strategy. And I thought, okay, well, actually, I thought it's a great, you use leverage. There's like some of the cash on cash or implicit cash on cash return there. There's the capacity for inefficiency, to have a discount in the price or, some value add component on certain properties, etc. So I thought it's a great, great asset. I was really happy with it. And so as I started investing, more professionally, I got interested in like using more data for that. So I would pull, let's say, thousands of on-market listings and then off-market information as well, and I would kind of price them, entirely. So let's say, and then if I have like more specific strategies, I would price out those strategies as well. Let's say, for example, one strategy I've been doing in the New York City area, and this is just like for some of my personal background, this is kind of to start with. So one of the strategies that I've been doing in the New York City area is condominium conversions. So I would, I would kind of like pull all the data, like multiple, like multifamily units of properties, and have like all the condominiums, sales comparisons data, etc., and kind of like try to find some inefficiency, some arbitrage, as they call it in finance, in the market. So that's one thing I have done successfully. And then they're having like various other strategies, such as, okay, can you find like with data like some more custom situations where you have a legal 4 unit that has actually a 5th unit, and you can kind of switch appraisal methods from residential to commercial, like this kind of inefficiency. That's one thing I have done. non-warrantable condos, like condos, if you have like a small condo building, those used to be previously harder to get financing on. So you might get a discount on those, and sort of trying to find like different opportunities, like zoning opportunities, etc. So that was kind of like the essence. It's a private, residential and like very small commercial, let's say, call it, investor. So that's that is how I started. The motivation was I just wanted to be efficient. I just wanted to be able to do it at scale. I wanted to not have to go through all the pain of manual underwriting. So that was the motivation.
I see. Got it.
Yeah.
Okay. And how, I mean, tactically, how are you pulling this data? Like, where are you pulling the data from, and what's like, what are you using to pull the data?
Yeah, I mean, so it's really like multiple. It depends on if we go the off-market route or on-market, etc. Now, the on-market, it's really one needs to use like various like MOS, because it's called like MOS API services, like REST services, I believe they call them, to actually do it professionally. And in my case, I would, for myself, I would just scrape various online sources and use that for my own investment decision, and obviously not distribute it to anyone, etc. For off-market data, that's actually very interesting. One can sign up for different API vendors like Realty Quant, and there's also a vendor called Melissa, and even Prospect Now, etc. And use those vendor APIs to connect to their endpoints and source, like commercial, this owner's data, and source, in addition to that, various rent estimates and rent data, and try to model commercial value add. So what I've been doing, like what I've been focusing, for example, now as a private investor in working to shift more towards the commercial space, is actually pulling various off-market data on commercial properties and trying to price out which are the buildings that are going to have the biggest value add. So it's sort of like have them ranked out. So if it's this market, let's say it's Atlanta, Georgia, or, let's say secondary, tertiary markets, whatever. So what's going to be the biggest out of those, 100-unit buildings, 50-unit buildings, etc. Which are the ones that they're going to have the biggest value add based on, what the data is suggesting. And obviously, get their owner and reach out to all the owners and send out, the usual way, send out all the direct mail, etc. But really do it more intelligently, where also have all the demographics per zip code and all that. So kind of like I don't even mail to zip codes where I don't like the the economic fundamentals there. So having it like super granular, and the property analytics as well, and that. But it's really a model. It's really a model very comparable to financial models that we used to build at my job before, where I would kind of model out what is going to be the commercial, what is going to be the improvement in value of that building that one can realize. Is it going to be 25%? How much you can raise the rents? It actually goes pretty advanced. Beyond the rent improvement potential, it also looks into some of like other income components. So it kind of sources rental listings data, where some of those rental listings may discuss, if various commercial multifamily buildings charge pet fees, administrative fees, etc. And then it can compare that to the immediate neighborhood. Or for example, whether, those buildings, that particular property charges, those various utilities, let's say, or not, and compare that to the immediate neighborhood. And then actually derive of that what's going to be the NOI improvement, like the net operating improvement. And to your audience, to those of them who maybe don't know, in commercial real estate, its valuation is derived of the net operating income of the property. It's predominantly the income approach. So this is really critical to have this kind of analysis and information to be able to predict which are the buildings that are going to do the best. And so that's one thing I've been doing, and kind of trying to do it at scale and do it for off-market commercial multifamily properties now. And I'm working at 6 states at the moment, and like pulling various data and trying to set it up.
I see. Got it. That's interesting. So what of, I guess, you mentioned several different strategies that you were testing out in New York to try to find, inefficiencies, and that now you're working in
They've
six
done,
different.
yeah, yeah.
Yeah,
In New York, that's what I've been doing in the past few years
I see.
already. Yeah, and now pretty much switching to the commercial space.
Yeah, got it. Okay. And what through all that, what's been like the most interesting finds or the biggest opportunities, or maybe is it a specific market or a strategy that you think has the most opportunity?
Good question. I mean, what is one interesting find in my opinion is, so if you take markets that are kind of depressed, that do not perform very well in price terms, so one would expect, let's say that's normal, regular to expect like those markets would have higher cap rates, for example. But one interesting find is, well, in those markets, if you actually they do have higher cap rates, but they often, due to their like extremely depressed status quo, that's an example of that is like various areas in upstate New York, and just to your audience. So there can be properties that ought to appraise by the income approach that we discussed, that are commercial, that have, let's say, 10 units or 6 units or something like that, but they really have a bunch of comparables. And since markets are really depressed and appraisers are very conservative, and they would kind of end up basically pricing them by comps, by comparables. And so, but one thing I have found is, if you do find, once you hit kind of the minimum threshold for unit count there, which is not 5, as would be in ordinary markets, but let's say maybe 25 or something like that. And then that would be actually, so then that would take advantage of the income approach, and nevertheless have like a really high inefficiency. And so it's kind of executing a short-term equity gain strategy where the property is really turnkey, and it's or approximately turnkey, but you just go in like very depressed markets, and you just literally just raise the rents. So that is one thing that I have found, and condominium conversions are another. So that's a fairly turnkey strategy. And I want to share actually that nearly every strategy that I have done myself has not involved extensive renovation. So that's pretty unique. So I have been able to realize, and they all have been equity gains. So I have been able everywhere to realize, let's say, an upside of very varying percentages, but minimum 25%, let's say, aiming for, obviously, right? It will make sense otherwise in real estate. And so to realize an equity upside on a time horizon of 6 months to a year, or maximum of 2 years roughly, is my target. And that has been all on actually sort of stabilized arbitrage, stabilized strategies. So that's unique. And so like I mentioned, the income improvement commercial side is one. Condominium conversions, second one. Various restructurings, regulatory restructurings, we're sort of financing the non-warrantable condos. So non-warrantable condos, that's if you have a small buildings, let's say it's a 3-unit, 4-unit condominium building. It was hard to finance that conventionally before. One could get a discount for it, and then finding out a quality lender who is actually able to offer good terms on the financing to potential buyers, it's kind of like an arbitrage that can result in an upside. So really these strategies, and the 4-unit to 5-unit thing is another one. Like I said, working in fourplexes, there are quite few, but there are some fourplexes that might have an attached unit, and it's not a legal unit. And I did that once upstate. So I bought a 4-unit. It had a 5th unit. I literally put in a smoke detector there, whatever like this, and that was the only value add, and it became a 5-unit, and it actually doubled in appraisal. But I've been able to
based on the NOI approach, based on
the NOI approach.
Yeah, got it.
And even though it's that's correct, and it's not a very it's more doable in cheaper areas. So it's kind of like a cheaper property. So it's not a a humongous gain, but it's still kind of doubling the appraisal of it. Yeah. And so it's that they've been able to discover with data. And so it's really the mindset where you pull thousands of listings, and even if they're on market, then you have capacity. Even if those are on market listings and you don't even do the off market part, it's going to be you can pull the top 0.1%, and in markets that are especially depressed, as far as if you're looking for this kind of flipping like equity gain opportunity, then that's definitely feasible. cash flows, like they're very high cap rates in some of those markets. It's another strategy. I've done Airbnb in New York City as well. I mean, in the New York City area, not New York City, like immediately in New Jersey.
Yeah.
City. So that's just as far as my personal strategies.
Got it. Yeah, that's super interesting. Yeah, it's as somebody who's like used brute force a lot more than I'd like to admit, rather than using my mind, like, it's like such a juxtaposition. A lot of people approach real estate investing, they're like, I need to go in and get my hands dirty and be the catalyst for the change in this property in order to realize these gains. And they don't feel like it's, worthwhile gains unless they're the ones like physically going in there and doing rehab or some other, work to realize the gains. But you're approaching it from the standpoint of where's inconsistencies that I can just exploit that already exists there and just create value where it wasn't. And I think that's awesome. I read this book called Effortless earlier this year, and I reference it all the time. It's an awesome book. Greg McKeown wrote it, and he talks about that a lot, where it's like, there's all these different ways to get to the outcome that you're after. And so why not do things in a more effortless way? And so, I think this is just such a perfect example of that, using data to find these little inconsistencies to exploit those things. So how do people work with, you said you're working in 6 markets. What, what's your process for working with, because I would love to like tap into this data as opposed to like trying to figure out how I can pull it all myself. Is that something that you offer, or how do you work with people?
Yeah. So I'm actually currently just right now launching a lead generation tool for commercial multifamily. It's going to be up in the next 2 weeks or so on RealtyQuant.com. I also offer market data for market valuations. So that's something I've been using super much for like out of state investing, because at the beginning of COVID, I was super concerned as to whether like certain markets may be overvalued. Can you to be calm? Can you be calm and just invest like continuously, in a potentially downward cycle as well? And I know many real estate investors, they kind of tend to think, okay, we buy a discounted property, we execute our value add, so we're protected. It's partially true. Of course, to the extent if you have a 20%, baked in, it's purchase, surely that helps you, and that's a great approach. But you don't want also all the labor for finding a deal to be wiped out by a potential downturn. So it did work at the beginning of COVID, which I felt was good, and I was proud of. That is like work on market valuations. So my company also publishes that. It's on realtyquant.com/analytics. It's a market valuations product, so they can see they can purchase a state, can see all the markets, like all the counties in that state and cities, etc., if they're overvalued, and some appreciation perspective. So that's basically what that is. And I can share actually, Kirby, if you like, some of that.
That'd be great, because as you're talking through that, I kind of am curious to know how you determine is something overvalued, and then where you're looking, where you think the best opportunities are right now.
Absolutely. So I'm gonna share my screen. I know it's a podcast, but if people want to go to see the video as well, I'm just gonna share one slide.
Yeah, you could just go to Living Off Rentals YouTube page and watch it on YouTube as well.
Right. So that's actually gone very interesting with inflation recently. So just to explain to people what I do here. So I just compute a market valuation. So I compute the percentage by which each state or county is overvalued. I do this for 2,700 US counties. And like I mentioned, it's published on RealtyQuant.com. So what I found was actually very interesting at the beginning of, so I was tracking this since March of last year. So that's when I started. I just was concerned since April of last year. So I was concerned about, COVID, etc. I did the analysis for myself, and I just wanted to find, okay, I don't want to invest in an overvalued place,
Mm-hmm.
And so what I found was the following. So at the time, one moment. Actually, I'm going to show you another slide first. Well, so what I found was the following. I looked at like what were the biggest drops during the global financial crisis in, let's say, across states and counties. And so the four states that dropped the most at the time were California, Nevada, Arizona, and Florida. So they dropped, like 40, 50%. So I was curious, and then there were other states like Texas that dropped only 4%, and North Dakota actually stayed flat, didn't even drop at all, and that was quite interesting. So I wanted to understand like what drove those, why some of the markets and states are not markets but broad geographical regions dropped so much and others did not, and so at the time I found like this. So it's a real estate valuation based on deviation from historical pricing correlation. Now that's like sounds really simple, but it really, what it does is if you take affordability in different markets and you take deviation versus a moving average window, you inherently capture other components, such as if affordability is getting shifted, moves upward in, let's say, large cities like San Francisco and others, where affordability defined as like what are the home prices versus the incomes of people there. And let's say this ratio is getting bigger and bigger over time, and we have San Francisco moving from, let's say, a ratio of 6 in the past to maybe 20 right now. And so that dynamic happens due to changes in like population and housing supply, so due to housing shortage. And so as one is takes a deviation in affordability versus a moving average window, so let's say 20 years back or 10 years back, etc., one is able to capture like a component that is not of pricing, that is not there due to incomes, population, or housing supply. And then at my company, I do it in the more advanced kind of regression-based way. But what I showed at the time was this kind of simple metrics-based approach. And so what it showed is that the states of California, Nevada, Arizona, and Florida, they were, like 40, 50, 60% overvalued. And so that was like quite in line with the drops that they experienced. And there was like 80, depending on data set, 83 to 87% correlation at the state level versus the subsequent declines that happened in different states. So that was very high. And the reason for that is, that it's actually so predictive, and I was quite impressed at the time real estate is a fundamental asset. So it's a fundamental asset. It's driven by basic fundamentals. If something deviates from those, one is actually able to capture it to an extent. And it is a bit harder for smaller geographies. Of course, now this correlation drops to about 75% at the county level. But again, this is 2,700 counties predicting the future of them. And so what was the valuation in the peak of 2007 and what it was afterwards. And so how does that look right now?
Yeah, and just to recap too, for people who can't see it, so basically showed a chart of how much overvalued each area was, each state was, between 2007 and 2009, and it's almost the exact same numbers as how much they dropped in every state, or stayed the same or went up. So those areas that are most overvalued were the ones that were hardest hit. So yeah, so that's interesting to look at today then.
Yes. So today, I want to give actually kind of a preamble that it was, when we say today, it's really different starting the second quarter of this year.
Okay.
Second and third quarter of this year, and different than what it was before. So when I was doing like this talk in 2020, so in 2020, the U.S. real estate was fairly valued, broadly speaking. So So there were a couple of states that were overvalued, notably at the time Idaho, and so that's not on the slide here, but just for your audience, in 2020, Idaho was the only sharply overvalued state at 25% overvalued. From there were like a few of the well-performing states were mildly overvalued, like Colorado 13, Arizona 13%, etc. And the states of Florida and Texas, where, you know, as many of your listeners know, those are the two big markets for multifamily in the US, right? And especially this market cycle. And so the states of Florida and Texas, they were staying for 4 years. And I started doing this in April of 2020, but I have a whole quarterly history of valuations, like where they were. So for 4 years, Florida and Texas stayed in the range of 8 to 10%, slightly overvalued, you know. So it's well-performing markets, but it was not a bubble. It was not a bubble. And so this actually, with inflation, it shifted in the second quarter of 2021. So in the second quarter of 2021, Idaho, which was at 25%, sharply, kind of abruptly jumped up to 47%. And so several other states like Nevada, Utah, 27%, Colorado, 20%, Arizona, 31%, 31 or 32%, depending on the data set. So, and the states of Florida and Texas, which I mentioned, where those valuations are actually quite consistent. Like I said, like one would watch them every quarter the same, or very similar numbers. They change, you know, if something obvious, you know, if a dislocation happens. And so Florida and Texas, 8 to 10%, they actually doubled in the second quarter of last year to not super high territory, but well, like 18, 19%, you know, or like 17 in one of the data sets, you know, something like that. And so that's the situation. So with that, I came out, I did a video for my webinar kind of saying, okay, my personal view and take is the US real estate market in the second quarter of last year is actually showing the first indications of a bubble. Now, doesn't mean it can last for 4 years ahead. So before 2007, US real estate was super fairly valued in 2002. Then between 2003 and 2005, it became, over just the course of 2 years, it became very overvalued. And then only 2 years later, kind of, you know, it burst or the correction happened. So that is that. And also it's not necessary that a correction does happen. It's possible that if something is overvalued, let's say you have Colorado 20% overvalued, it's possible that it actually resolves in a different way, such as income super growth. That is feasible now because some of those overvaluations are stemming from very high asset inflation that is not matched by wages inflation. So it's some of the, I would say that some of the caution for investors now to say, okay, you know, if you hear the narrative of invest in hard assets because there is inflation, yes, I agree, that's correct, but only if it doesn't result in differential inflation versus wages, in which case you might get trapped in a heavily overvalued, an increasingly overvalued place that might correct in the future. And so some of that happened in Arizona the second quarter of last year, where at least in this framework, where it was, you know, about just like 15%, you know, slightly overvalued and kind of doubled to like 31, 32%. And that's because really prices in the first half of last year in Arizona grew by statewide like 17%, and incomes grew by only 1%, and so it's kind of like this kind of dislocation. So some of that might slow down, some of that might come down a little bit. Hopefully, actually, I'm hoping for that in the scenario of you know, wages experiencing like very strong growth. So yeah, so but it's quite interesting. It's quite interesting because like I said, there's an economist at Bloomberg Economics were reporting since 2019, like in different countries, how overvalued or undervalued they are. And US real estate was fairly valued even until basically until early in 2021. And then Canada, Scandinavia, like Sweden, and countries in like Oceania region, like Australia and New Zealand, were actually very overvalued. And then the United Kingdom, to some extent, a bit less than them. And then US was actually at fair valuations in real estate. It was quite interesting. And that's what we were experiencing as investors. That was our intuition. It's not like, I know people complain about certain properties being like super overvalued, but it wasn't like, there wasn't the sense of like a bubble or something like that. While last year we started hearing about, in Arizona, like some of the excessive rent growth of like in Phoenix, like over 20% and so forth. And so my take is like some of the initial beginnings of a bubble there. There's no timing to it. There's no sense as to, how long it's gonna last. It's hard to, that's not something one can predict. In some of the cities, so Boise in Idaho, if some of your audience, if they know Neil Bala, the data scientist, multifamily investor, so he talks about like, like good markets to invest in. He has often reported Boise as the strongest market this market cycle. This is correct. Boise has the strongest price appreciation since its last fair valuation, so to say, but it also went very overvalued. And so Boise, like my estimates, so it's going to change now with the end of year data, but my estimates about 58%, very, very overvalued city. Wow. So that's, that was already, even at the beginning of COVID, was already overvalued, was the most overvalued city. And that's like out of 800 cities with more than 50,000 population, it's the most overvalued one. There were other well-performing cities at the time that were outstanding, that were like in the top 5 or top 10, like Denver, which were actually fairly valued. So Denver had performed extremely outstanding, and yet its incomes and all other fundamentals had caught up apparently, or were fine. And Denver at the beginning of COVID was like at 0%. Now that changed a bit, and I can look up like some of the numbers here. Perhaps Denver is now at 12% or something like that. But again, like some of the very well performing places that are very trendy with investors, only some of them have gone a little bit overvalued. Boise very much 58, but then Phoenix, I believe this is really an estimate. Phoenix went to about 30. And that's really just the second and third quarter of last year. It was all very much milder before. And then a few cities in Texas, Odessa, Texas seems to be the most overvalued one in Texas, actually.
Interesting.
I mean, Austin to an extent, of course, as well. So Austin, like 23%, Salt Lake City, 22, etc.
And how do you, I mean, I know you're looking at primarily, it sounds like valuation compared to like income. And so we look at this chart that you've got up now, which is each state. And so Illinois, I notice right away, because that's where I'm from. And it's also the absolute lowest on here. So it's showing that it's 16% undervalued right now. So immediately I think, well, that must be an opportunity. But then I think about just having sold all my assets there because it was miserable to deal with the type of decision making and taxes and all this stuff that goes on in Illinois. So how do you, I guess, how do you decipher through the other factors? Because this, if you just looked at this, you'd probably think, well, that's an opportunity. I should go buy in Illinois.
Yeah, and just to clarify, actually, no, because it's a little bit counterintuitive, but valuation is a measure of downside risk. So it's really, if a market is overvalued or undervalued. So if a market is undervalued, it's telling me that it's not going to drop past the future peak. So all the undervalued states in 2007, their average drop was 4%.
Right.
So 4% was, or median drop, however. So 4% was also the average income drop in the US at the time. And so in essence, one can say that in valuation terms, they didn't drop, high level speaking. So it's like their incomes shifted and they shifted with that. So that was interesting. So it's really, so that's the narrative that's the story here for places like Illinois and sort of those are really depressed states, so they're not that's not an appreciation predictor. It's just, that's the key here. Like, what is the variable we're trying to predict? It's only downside. So this is the best. And I actually tested like various things. I was looking at foreclosure rates. I was looking at price volatility in different markets. So it happens to be that real estate is very fundamentals driven, and it's driven by, it's driven by incomes, population, housing supply. And that's kind of what inherently is here, because it's really those three variables that come into play. And so And so that's, it's a downside predictor. Does it predict appreciation if a place is undervalued? No, it's actually a negative predictor of that even. So it doesn't help. To predict appreciation, one needs to look at, the usual fundamentals that people look at, like job growth, population growth, etc. Or real estate has momentum in most places. So Florida, I did a study for autocorrelation. So autocorrelation is how much the price growth this year correlates to the price growth last year in, let's say, Florida. And so Florida had like 79% autocorrelation. So if one wants to predict prices, whether, let's say, in currently overvalued in this framework, Arizona, are the prices going to perform strong? Yes, in all likelihood they will. They will continue performing strong. However overvalued it may be, they will continue by autocorrelation, by momentum. They will continue going on and on. So if I wanted to predict the best appreciation, it's going to be the same places that performed very well, which in this point of the cycle do tend to be some places that are actually overvalued. So it's going to be in Arizona, it's going to be Idaho, etc. So why? Because that's what autocorrelation is telling us in the data. At least that's my perspective. So that's what there is momentum. There are a few markets like Alaska, for example, that don't have actually negative autocorrelation, and that's unusual. But the majority of them have trend, and that in finance they call this weak form efficiency, or weak form inefficiency rather. If historical prices, if they end up predicting future prices, it kind of means the market is not even weak form efficient. So in US real estate, by doing this kind of autocorrelation test, it's actually in the majority of states and markets, it's not weak form efficient. And so that's a very quick, like easy way, like when just has the history of prices, just pull like what's the autocorrelation, just like what has been the price performance. Now to know price performance, one needs to know like where to start, like at which time point. So that's kind of what I do, like to kind of teaching people how to pick markets. So you need to know when real estate was fairly valued, because if you take Florida, Florida is according to like investor intuition, one of the best states. So in the whole eastern half of the US is the very best performing state, is what most professional investors would say, and where big investors invest as well. Now, Florida prices at the beginning of COVID were roughly at their 2007 peak. So it's like, then it's like one could wonder, is this really strong over the long run, like a strong performing state? And the answer is yes, because, well, in 2007, it was sharply overvalued, and that was distorted pricing, like 50% distorted. If you take it at the correct time point in 2010 or etc., when it was fairly valued, then you get the accurate appreciation, and then you see the picture. Okay, Florida is actually the really strong performing state in over there. So to pick the best markets is running regression analysis on population, income growth, and housing supply. That's all. It's not hard. Yeah, it's not hard, and that's how you pick like the best markets. But because there may be a part where prices perform beyond their fundamentals, as it is now, it could actually be more predictive to just purely do an autocorrelation test on the prices themselves in Arizona, let's say, and that's going to be your predictor for next year appreciation. And you pair this with the downside risk side with market valuations, which is what like one of the products that my company offers. You pair this with market valuations, and now okay, that's your downside risk after that. So
that's what I was wondering. Is because auto correlation only works if the market continues to go up, right? I mean, if there's crash, then it would make more sense to be in a lower valued market, right? Like an undervalued market, because you're not going to get that autocorrelation from the year before, because there's obviously a totally different market.
At that point, is going to break. Absolutely, that's completely correct. And at that point, it's going, and that's why what I say to like some of my colleagues, also like investors, my view is, like how people like to look at like all those fundamentals, population, job growth, etc. My view is, okay, those are reflected in the price already. Now, if you want to look at them in the future, then it means, okay, you're trying to predict, let's say, population growth of the past population growth and things like that. And I tried doing it. even if people go in Excel and they try to forecast population forward with the function that the formula that Excel has, I forget the name, like forecast something. And so that formula even uses machine learning that for forecasting time series. And so, but try to look at it like I did it like for different regions, and you look at like what the population growth projections are going to be, and they're totally arbitrary. It's like really hard to predict population in the future and things like that. And so if let's say syndicators or investors, they go and they pick markets, okay, and they look at, oh, they've had this population growth, this income growth, etc. I mean, that's already baked into the price. You can just look at the price as well, So that's that. And what's not, if it's not baked into the price, or if it's over baked into the price, then that's valuation. So to me, the purely market side, I have like, if people look at like some of those reports here, I have like the various like income, housing supply fundamentals, housing supply performance, etc., and whether housing shortage is developing and things like that. But to be frank, I don't look at them so much myself, because it's already, all I need to know is the prices, where the prices are performing, what the autocorrelation is of them, let's say, and to know valuation for downside risk, and that's it. Because all fundamentals, like I said, are baked into the two variables of the current price performance, and if that price performance was excessive or under excessive, or less, or etc., which is valuation. So that is like kind of my somewhat a little bit, it's both simple and it's also like a little bit unique approach to market selection. So here, like again, like to your question, let's say, so where can one go at the moment? I mean, that's a question of risk preference, of course, and taste. So I was doing the choice, like I mentioned, like picking states for like commercial multifamily, and so my choice at the moment is where it's not trendy. It's in the Midwest, and it's potentially just because I happen to be in the Northeast, even a little bit for personal investment in the Northeast. And now, but it's really places like, well, actually where we are, Indiana, and Ohio, and Kentucky. And why? Because if you look at like here on the map, okay, that's with the heavy asset inflation that happened. They went like 3-4%, fairly valued, slightly. You cannot even call it overvalued, right? Fairly valued. And so that's and yet, if one looks at the Midwest and looks at price performance since the last fair valuation, so Indiana has the strongest one. So the Indiana has one sees like, I don't know, well, that depends on the data source. So it's like in FHFA was 58% above, 58% up this market cycle is the state of Indiana, which is pretty healthy, pretty healthy. And it has stayed fairly valued. So it's really, it depends on what one wants. Now, if I want to do like a very short-term play for like 1-2 years, then I would go in Florida with its great price performance and its very high autocorrelation, where if one enters for 1-2 years, even though it's overvalued, it's going to be, or maybe for 5 years, I don't know the timing, obviously, but dependent on like risk tolerance, one could try to play this kind of appreciation, but it's already starting to get thinner and thinner. Now, if people now enter this point in Arizona, now in this framework, let's say I wouldn't do it personally. Now it's a taste. Now I wouldn't do it already at 31%. I just feel like, okay, it's, even though again, that area is going to perform again outstanding. It's going to continue like we discussed. So it's not I'm saying, oh, because 31%, it's not going to continue doing great. It's going to the opposite. It's going to continue doing great. It's just that, for how long? And let's say if you have a 5-year horizon, you experience a lot of appreciation, then you experience a downside, and it's just like it becomes a bit of a gamble. And so that is really that's really some of the concerns. So for me, like, since I am perhaps relatively risk averse, I use this data to say, okay, if I am in an undervalued county and an undervalued state, I know that I'm not going to experience a downside even if the market takes a downturn. I have seen that in the data in 2007. Even if there is a big correction, if I'm in an undervalued county, in an undervalued state, I will be fine. I'll have like just a 4% drop or something by income like it was then. In fact, I had, at my webinar, I had like if some of your audience knows Vinny Chopra. So Vinny Chopra, famous investor, and he, or like multifamily investor, right? And so he So he shared the deal that he did in Texas that he purchased in 2008. And one would think, wow, he bought it at the peak of the market. It's like one of the worst times to purchase. That was his first multifamily syndication. And he said he made like 60% IRR or something, or like it was a huge IRR on that deal, like very high return. And I was thinking, okay, well, actually, I get it. Okay, so apparently separately it was a good deal, but I get it how it worked because Texas was undervalued. So he had no effect, no price effect whatsoever. It's like he bought it at another time. And so whoever now invests in the Midwest or and Northeast, and then it's obviously the Northeast is depressed as well. So there are good reasons. So one should not expect much much appreciation, but it will be definitely bigger downside protection. And so it's really picking like a good combination of price, performance, and valuation. That's all. So it's really okay if Indiana, like I said, if Indiana has 58% performance this market cycle positive, and it's fairly valued, well, that seems decent. So that's like one approach. Do I want to go in Arizona that has a price performance of 122% this market cycle? It's huge, but okay, but now it's 31% overvalued. Maybe it's playing it risky. So that is my approach to market selection.
Got it. Wow, that is awesome. It's super interesting to hear you break it down like that. Yeah, I mean, I think the bottom line is, I mean, fundamentals are going to dictate. Like, you can't just, if you're just trying to pick a market because it's been down or been up, or you think that a crash is coming, I think you're always going to run into problems. But this, I think, pulls actual historic data, and you can kind of start to see the combination of upside potential plus the downside protection. And I think that's the key to this. So if somebody wants to get this data, did you say, can they go to Realty Quant? Is that how?
Yeah, they can go to realtyquant.com. So I actually recently launched it as a product. It's a lifetime subscription, or it sounds like a lifetime. Well, they get like lifetime free updates. So they can just purchase a state, and they get lifetime free updates quarterly. So they would always know, like from there, they would always know if it changes, if their market then goes overvalued or something like that. And that's pretty much what I do and what I use for my own investment on the market side.
And is this all real estate or just multifamily?
No, this is really more. In the residential. It's not the commercial real estate space.
Okay.
It's governmental data. The sources for this are really just like all governmental agencies like FHFA and Bureau of Economic Analysis and Census, etc. It's it's free governmental data to assess markets. So yeah, it's really leaning towards. I mean, I did a study versus commercial. Did like just like what's the correlation of CoStar's index, NAREIT or something like that, and then FHFA index, and it was like 91% price correlation, but they're not the same thing. It's a valid point. And like commercial multifamily investors, they tend to think they're protected. They tend to think that they have control over the valuation. They do have at the entry point, of course, control. Now, they do not have control of the market cap. I guess that's how, like the same way, like in finance, because they come out of like option pricing background. And so in option pricing, like option traders would quote the prices of options because like implied volatility. And let's say you have, and it's really just an input variable to the price, but because it's such a prevailing input variable, they would just quote it by that. And so I feel like in commercial real estate, it's a little bit like that, where, investors but it's the market cap rate. And so, okay, you can change the NOI, but the market cap rate is going to shift, and that's your price. That's your real price. And so so you really one is subject to similar. Fundamentally, it's driven by the same fundamentals. It's just a different valuation approach. But again, it's just people living there who are earning, their income and having housing. So that doesn't change,
Yeah.
And
Yeah, that's been my challenge with multifamily as well, that I've brought up to several multifamily investors, asking them like, how do they look at that? Because cap rates have been in our favor for the last 10 years.
correct.
So they just keep going down, and values keep going up. And so what happens if, like you said, that's just an input that so all of a sudden the market cap rate is different, and it goes up. Even if you're improving rents, you might not be able to keep up with that cap rate. So yeah, it's a interesting, I that's why I haven't been able to wrap my head around multifamily deals recently. But I know every investor is different.
Absolutely, and that's a great comment. Or inflation. I think like inflation is the hot topic right now, right? So I feel there's so many investors who think that, okay, because there's so much liquidity pumped into the system, so asset prices are going to go up, and that's true. But just guess what? If fundamentals don't move according to, you still have fundamentals, and that if they don't move according to the same inflation, you might get bubbles. And that's, everybody now seems to think, like I have this, like with all my friends who are investing, etc., they seem to think that, they're protected. It's not the case. It's again going to form a bubble. It's not protected. The fact that, like it's like I said, the fact that if we have in Arizona, due to the liquidity, due to the inflation, prices now increase last year significantly, it doesn't mean that they increase to the rational extent. It doesn't mean now we need to see wages increase as well, and other fundamentals move accordingly. And if the liquidity pumped into the system results in that, sure. But I mean, I listened to a presentation by my undergrad economics professor who was saying that, how kind of giving a history of several hundred years of inflationary cycles, and they tend to end with, let's say goods inflation, and, becoming way higher than, than let's say wages inflation. And then at some point, it can take a while. It can take 80 years ahead and so forth. But at the end of this cycle, historically, and I'm not sure what's going to be now, maybe it's going to be different, but it ended up with kind of, poor to middle class people kind of coming out in the street and overthrowing the government code, so it's just because things became so expensive relative to wages. So it's just, this is, I think, the question always, it's, of course, I'm happy myself about now inflation and let's say my assets increasing in value, but one needs to know if they increase too much and know when to sell. And so that was my effort with this kind of market analytics side.
I see. Yeah. It's really, really interesting stuff to look at. And I really appreciate the breakdown. I know we could talk a lot. I mean, it could go on, this conversation could go on for a very long time because there's no limit to the data you can analyze. So, but this is a really good overview. And I think if people want more information, they can go to Realty Quant and get, they can actually look at some of these charts themselves. So I appreciate you sharing that with us. I guess last question. Well, you said Realty Quant is the best way to get a hold of you, right? Yeah. Okay. Got it. Yeah. So go to realtyquant.com, and I really appreciate your time today.
Thank you. I really appreciate it as well.
Yeah. Talk soon.